Good morning, and welcome to the Bulls, Bears, and the Bell Morning Edition. Thanks for joining us. We're diving into what looks like, well, frankly, one of the most complex and volatile mornings we've tackled this year. Our mission today is pretty specific. We're decoding the source material titled Market Update, Futures, Movers, Calendars. It's a snapshot from right now, October 17th, 2025, pre-open. And just reading through it, it's clear this isn't just market weakness. It reads like a blueprint for some pretty acute investor anxiety.
That's exactly right. You look at this material, and the core theme that just jumps off the page is this shift. We've moved past typical uncertainty, This feels like genuine systemic fear.
Right.
The market's deep in risk-off mode, but this feels different. It's not just about high rates anymore or growth worries. It's this sudden, almost terrifying concern about solvency.
Yeah.
About counterparty risk, especially in the banks.
Okay, so we need to move fast, but be thorough. The opening bell isn't far off. Our goal here is to cut through the noise. First, let's try and quantify this anxiety, and some of these numbers are really staggering. Then we need to pinpoint the catalysts. What's driving this? Especially these banking fears popping up again and the geopolitical stuff. And finally, we have to look at this huge divergence. It's like one part of the market, tech, is living on a different planet than everything else, especially financials.
Yeah, the initial picture really sets the tone, doesn't it? It's just widespread fear. That first snapshot, U.S. index futures, they're signaling big declines, over 1% across the board.
Wow.
This isn't some minor dip. This is pointing towards a sharply lower open, completely driven by fear. It tells you the big money, the institutional players, they've already been heading for the exits overnight.
Okay, let's put some hard numbers on this anxiety, because the evidence for this risk-off mood is, well, it's undeniable. Looking right at the futures market. The selling is broad, really broad. Dow Jones Industrial Average futures down a hefty 492 points. That's 1.08%.
Yeah, significant.
S&P 500 futures, even steeper, down 1.29%. But the NASDAQ 100 futures, off in the risk appetite gauge, right? That's leaning the way down. A full 1.35% drop.
And when you see all three major U.S. indices down over 1% before the cash market even opens, that signals a real consensus.
Among the big players.
Exactly. Global funds, large institutions, they're not waiting around for liquidity. They're actively, maybe even aggressively, cutting exposure. It's like the negative vibe globally is translating directly into these heavy losses in U.S. futures. It suggests a strong institutional belief that today is going to be dominated by selling pressure.
And if you want a measure of just how panicked institutions might be feeling, you look at the VIX, the CBOE Volatility Index. We often call it the Fear Index. For folks tracking, it's really a measure of expected volatility in S&P 500 options. Our sources show the VIX. It's surged over 22% recently, and it's up another 6% this morning, hitting 26.89.
That 26.89 number, that's really key. It's the highest close for the VIX since back in April.
Yeah, what does that actually signal?
Well, think of it like this. VIX over 20 usually means uncertainty. But when you cross 25, like we have now, you're in a zone of acute market stress. This isn't just caution. It signals something closer to institutional panic. It means the market is pricing in really high odds of large daily swings, big percentage moves.
Like a multiple percent swings.
Potentially, yes. It's the market basically shouting, we expect extreme turbulence and we're willing to pay a huge premium for protection like options. The anxiety level is just palpable.
And that kind of anxiety forces this flight to safety, right? We're seeing this massive, almost panic-driven shift in where money is going. The most dramatic evidence, gold. It's rocketed to a new record high, $4,378 an ounce.
The price itself is stunning, absolutely. But when you dig into the source material, it's the speed of the move that's really alarming.
How so?
Our sources highlight this. Gold's weekly gain is nearly 8.5%. Just think about that. To find a weekly jump that big, you have to go all the way back to the peak of the 2008 global financial crisis.
Wow. Okay, so this isn't just hedging inflation anymore.
No, definitely not. This isn't some casual long-term inflation hedge. This looks like an aggressive wholesale shift out of risk assets, maybe even out of traditional safe things like government bonds.
That raises a really important point. Why now? We've had rate concerns and inflation worries for ages. Why the 8.5% spike in gold this week?
That's the critical question. I think it speaks to a potential breakdown in what people consider safe. Usually, in volatile times, Money flows to the US dollar, maybe short-term treasuries.
Right.
The fact that gold is moving this violently, along with the VIX spike, it suggests investors might be worried that even the perceived safety of government paper, of fiat currencies, could be at risk if there's a real systemic credit crunch.
A fear that even the traditional safe havens aren't safe enough.
Kind of. It's this deep systemic fear, a worry that if major financial institutions start to wobble, even government-backed assets might face pressure. So you see this intense, almost vertical move into gold, the oldest form of hard currency.
And it's not just gold, right? The sources mention silver, too.
Exactly. Silver's also hit a new all-time high. When you see both major precious metals moving like this together, it confirms the market is prioritizing absolute protection. Protection against financial instability above almost everything else.
It confirms that panic shift.
Precisely. This broad rally confirms a really deep-seated, generalized fear driving huge capital flows into tangible assets, things outside the traditional financial system.
Okay, so if the symptoms are record gold and a VIX over 26, we need to diagnose the disease. The source material seems to point pretty clearly to a critical shift in what investors are afraid of. It's moved away from just interest rate risk
Right.
and towards what we're now calling a budding credit crisis.
Yes, and this shift, this transition, it's the main accelerant for the really sharp downturn we're seeing now. Think about it. For the last year or so, the market talk was mostly about valuation. Are tech stocks too pricey with high rates? Are margins getting squeezed?
Manageable problems, kind of.
Manageable within a stable system, exactly. But now, that narrative, the idea that the Fed had contained those earlier banking problems, that the system was fundamentally stable, that narrative seems to have shattered.
And according to the sources, the trigger point came from regional banks.
It looks like it. The key catalyst mentioned is reports from two specific U.S. regional banks, Zions and Western Alliance. They flagged unexpected, pretty significant losses on bad loans, and in some cases, there were even allegations of fraud.
Hmm.
Now, the importance isn't necessarily the size of those specific banks, it's the implication. It immediately sparks fears about risk management, about lending standards across the board. Is the quality of loan portfolios okay? Especially for banks exposed to commercial real estate.
And this fear spread quickly. It didn't stay contained to U.S. regionals.
No, not at all. It pretty rapidly became a global systemic worry. We're seeing major European banks, mention Barclays, HSBC trading down sharply, seemingly in reaction to the U.S. news.
So global investors are seeing potential contagion.
That's what it looks like. They're connecting the dots. If credit standards are potentially lax in the U.S. regional system, what about the ripple effects? Through derivatives, interbank lending. Counterparty risk is global. Systemic risk means everyone's connected. The health of one bank depends on the health of others. When the weakest link starts to look shaky, even the strongest links can start to wobble.
You made a distinction earlier, and I think it's worth revisiting. Why is this fear credit risk, counterparty risk? Why is it fundamentally more terrifying for markets than the inflation and rate fears we had before?
Yeah, it's a crucial difference. It's really the difference between a potential slowdown and a potential crash. Inflation and high rates. Those are problems of growth and valuation. They mostly affect what a company might be worth down the road. But credit and counterparty risk, that deals directly with solvency, with immediate liquidity. It questions whether financial institutions can actually meet their immediate obligations. When the market starts worrying that a major institution might fail, when you worry if you can get your money out, that dynamic is just fundamentally more destabilizing, both structurally and psychologically.
And we haven't seen this specific kind of fear driving things since.
Not really since 2008. We haven't seen this type of intense solvency fear gripping the broader market like this since the global financial crisis. And that history, that memory, definitely colors the panic we're seeing now.
And layering on top of this, making things worse, we have these other headwinds. Geopolitical issues, domestic problems.
Yep.
Let's start with the global picture. Trade tensions.
Right. The sources note the escalating U.S.-China trade friction. That's just this constant source of uncertainty, of unpredictable risk. We're seeing specific actions mentioned. China retaliating against recent U.S. tech restrictions. For you listening, this matters because it makes it incredibly hard for multinational companies to plan things like supply chains or long-term investments. Uncertainty leads to pulling back on capital spending. And when you add that to an environment already worried about credit, it acts like an invisible drag on global confidence.
And then there's the domestic issue, amplifying all this fear. The U.S. government shutdown, now in its 16th day. according to the sources.
Yeah, this is a classic case of political dysfunction making a financial situation worse. The shutdown creates what some call a data vacuum.
Meaning we're not getting the usual economic reports.
Exactly. Think about what's being disrupted. Timely inflation reports like CPI, PCC, key consumer confidence numbers, jobs reports, GDP estimates. These reports are the tools. They're what the Fed, what institutional investors use to gauge the economy, to model risk accurately. When that data isn't available or it's seriously delayed, rumor and speculation tend to fill the void. This lack of official objective data leaves policymakers and investors flying blind, essentially. It makes the market much more prone to panic based purely on fear. The vacuum turns uncertainty into just blind risk.
Okay, so this intense system-level fear is creating a really fascinating split in the market, a bifurcation almost. It really is a tale of two markets right now. You've got what we could call a macro-driven market stuff getting crushed by these big fears, and then this micro-driven market, mostly tech, that seems weirdly immune.
This divergence is absolutely key to understanding the market structure today. That macro-driven group cyclicals like materials, energy, and definitely financials, their fate, is tied to those big solvency fears we just discussed, tied to the health of the global financial plumbing. Then you have the micro-driven side, dominated by technology, particularly AI, that seems governed by these powerful company-specific growth stories, secular trends that, for now at least, seem resistant to the credit worries.
Let's start with the victims then, the bearish side. The sources mention Interactive Brokers, IBKR, down almost 4% pre-market. Seems like a perfect example of the macro just overwhelming the micro.
It's a really stark example, isn't it? IBKR actually reported strong Q3 earnings, beat estimates on both earnings per share and revenue.
Which normally means the stock goes up or at least stays stable.
You'd think so, but instead, it's plunging. IBKR is just a clear victim of this sector-wide contagion fear. The market is basically ignoring the good company news, how well IBKR is actually doing, because the systemic risk, the worry about stability in the whole brokerage and financial custody space is seen as way more dangerous right now.
So the market's saying, your profits are nice, but I'm worried the whole system might crack.
That's pretty much the message, yeah. I don't care about your quarterly numbers. I care if the counterparty system holds together.
Okay, moving beyond financials. Eli Lilly, LLY, mentioned it down over 4.24%. This seems to bring in another kind of risk, political risk.
Right. Even companies with huge fundamental growth aren't immune to everything. The LLY decline follows comments attributed to the U.S. president, suggesting potential significant price cuts for weight loss and diabetes drugs.
So regulatory fear hitting a high flyer.
Exactly. When just a comment, potentially, from a regulator or politician can knock 4% off a company's value instantly. It injects this immediate layer of political uncertainty. Suddenly, if you're an investor, you're not just modeling drug sales. You also have to model the risk of government intervention, which discounts those future earnings, regardless of how successful the drugs actually are in the market. This is like domestic political risk hitting valuation.
And then Albemarle, ALB, the lithium producer, falling over 4.5%. This one feels like it's getting hit from two sides.
Yeah, ALB is kind of at the crossroads of these global fears. First, it's a cyclical material stock, so it naturally gets hit hard when there's broad risk-off sentiment. If the global economy tanks because of credit fears, demand for things like EVs and therefore lithium is expected to fall.
Makes sense.
But second, it's directly exposed to those geopolitical fears we talked about. Those rising U.S.-China trade tensions create specific worries that the EV supply chain, which is critical for lithium demand, could get disrupted. So you've got worries about future demand and worries about supply chain stability hitting it at the same time.
All right, now let's pivot. Let's talk about the resilience, the micro-driven success story. Semiconductors and AI. This seems to be the one area that's genuinely pushing back against the systemic fear.
Yeah, this is where you see that long-term secular trend just completely overpowering the immediate macro pain, at least for now. The key catalyst mentioned in the source material overnight was Taiwan Semiconductor Manufacturing Co., TSMC. The report notes TSMC raised its revenue growth projections for the second time this year.
In this environment.
Exactly. That's a hugely powerful signal. It's saying the underlying demand for AI infrastructure for advanced chips isn't just strong, it's actually accelerating, regardless of what's happening with U.S. regional banks or European banks.
And that good news from the leader, TSMC, it ripples outwards. We're seeing other chip stocks rally.
Absolutely. There's a massive tailwind effect. Other chip makers mentioned, like Micron, MU, and ON Semiconductor, on rallied over 5% just on that TSMC news. Their businesses are plugged directly into that powerful, seemingly inelastic demand for AI, for data centers, for advanced computing. The spending needed for this AI transformation is seen as almost non-negotiable for companies, for governments. That makes the demand feel somewhat independent of short-term credit issues or banking worries.
So investors are basically saying, we're scared about the financial system, but we're still betting big on the future of AI.
That's precisely the message the market is sending. This sector right now is acting almost like the only safe haven within the equity market itself.
Okay, let's look ahead a bit. The market's on edge, waiting for some key economic data points coming up. These could either put in a temporary floor or maybe even accelerate the selling. The critical data dump is at 8:30 a.m. Eastern, and how the market reacts will tell us a lot about its current mentality.
Yeah, the focus will be intense. At 8:30 a.m., the really critical one is import prices, the month-over-month figure for September. Consensus is looking for about 0.1%. Now, we also get housing starts, building permits around then, and industrial production at 9:15 a.m. But the market's immediate gut reaction is likely going to be driven by those import prices, that global pricing signal, and specifically how any deviation from that 0.1% forecast gets interpreted.
Why are import prices so crucial right now? Especially when the main fear seems to be credit, not inflation.
It's because the market is almost desperately looking for anything that justifies Fed intervention. Normally, right, a low or negative import price number might be seen as good news signals disinflation.
Less inflation pressure.
Right, but in this environment, fear-driven, potentially recessionary, a lower than expected number is likely seen as negative for the economy because it reinforces fears of slowing global demand, economic contraction. But here's the paradox. The market might actually treat that bad news about demand as good news for Fed action.
The bad news is good news regime.
Exactly, we'll get to that. And speaking of the Fed, we do have some commentary scheduled later today, too.
Good speaking.
Fed Governor Muslim speaks at 12:10 p.m. Eastern. Given the, pretty severe stress we're seeing flare up in the banking sector, and remember, financial stability is part of the Fed's mandate, his comments will be watched incredibly closely.
What will people be listening for?
Any acknowledgement, explicit or even implicit, of this banking stress, and, crucially, any hint of a dovish tilt, any suggestion that policy might ease up because of these stability concerns, the market's focus is purely on potential damage control from the Fed right now.
Okay, so this leads us right into that bizarre phenomenon you mentioned, the one that characterizes markets in deep distress. The bad news is good news regime. Can you break that down? Because it really goes against basic economic intuition.
It does seem irrational, but it becomes rational sort of within the specific context of systemic fear. Right now, the market is pricing in an incredibly high probability. The sources mention a 97% of a 25 basis point rate cut at the next FOMC meeting.
A 97% chance of a cut.
Wow. It means the market has already basically decided that this credit situation is serious enough to warrant a powerful response from the Fed. That expected Fed pivot, that potential cut, is now seen as pretty much the only thing standing between the current fear and a much worse credit crunch spreading.
So weak economic data actually becomes desirable.
In a twisted way, yes. Weak data, like maybe those import prices coming in lower than expected, or weak industrial production, that kind of news, might actually be cheered by the market because it strengthens the case for the Fed cut that everyone is now desperately anticipating. The market's primary focus has completely shifted. It's not about economic performance right now, it's about the central bank's reaction. The bet is that bad economic news forces the Fed to step in, provide liquidity, provide stability that the financial system clearly needs. This whole inversion. It's the classic sign of a market prioritizing immediate survival, liquidity, over longer-term fundamental health.
Which brings us to what might be the single most important event of the morning session. Today's pre-market earnings reports. These are heavily weighted towards major financial firms, and given everything we've discussed, they're essentially acting as a live, unscheduled stress test of the U.S. financial system.
That's absolutely the right way to frame it.
Yeah.
The market's biggest fear right now is whether these problems we saw flare up at Zions and Western Alliance, are they just isolated issues at poorly managed regional banks? Or are they the canary in the coal mine? Do they signal a wider rot in loan quality across the whole economy, maybe made worse by higher rates and a slowing backdrop?
Yeah, and today's big bank earnings are the test case.
They're the potential firebreak, or they could be the confirmation of the worst fears.
Okay, let's break down who's reporting and what specifically investors will be watching. The sources mention American Express, AXP, Truist Financial, TDF, State Street, STT, and SLB Limited. though SLB is more energy services. The focus is really on AXP, TFC, STT.
Right. For AXP and TFC heavily exposed to consumer spending and commercial lending, the absolute key metrics are going to be credit loss provisions and delinquency rates.
Explain those quickly.
Credit loss provisions are basically the money banks set aside because they expect some loans to go bad. If AXP reports a jump in credit card delinquencies, or if TFC significantly boosts those provisions, that directly confirms the market's fear that loan quality is getting worse across the board.
And for a commercial lender like Truist, TFC, any other specifics?
Yeah, for Truist, you'd also look closely at net interest margin, or NIM. That's the difference between what banks earn on loans and what they pay out on deposits. If NI is falling, lending is becoming less profitable, and also non-performing loans. That's a direct measure of loans that are already past due, a clear sign of distress. For State Street STT, it's a bit different because they're a custodian bank. The focus there shifts more towards asset flows. Are big institutional clients pulling money out? That would signal a deep lack of confidence, maybe even in the safety of holding assets there. Also gives a read on institutional investor sentiment.
Okay, so based on what AXP and TFC report in particular, we can see two very different market reactions today. Let's start with the bull scenario. What does the fire break look like?
Right. The bull case needs these big, diversified banks, AXP, TFC, to report stable credit metrics. That means delinquency rates holding steady, maybe even improving slightly, and they need to sound confident about the near-term outlook. If they can show their loan books are basically okay, that acts as that critical fire break. It would suggest the regional bank problems were more isolated, maybe due to specific bad management or concentrated risks, rather than a sign of systemic rot spreading everywhere. If that happens, you'd likely see a pretty significant relief rally, at least short term, because that core fear about solvency gets pushed back momentarily.
Okay, and the flip side, the bear scenario. What if they do confirm the market's fears?
If AXP or TFC flags worsening credit quality, or if they announce they're dramatically increasing their loan loss provisions, well, that basically confirms everything the VIX spike and the gold rally have been screaming at us. It signals the problem is systemic. It's spreading through the whole U.S. financial system, hitting majors, not just regionals. If that's the message from these earnings, you could expect to see a massive leg down across the entire financial sector, and frankly, probably dragging everything else with it. Performance across all stocks would likely become highly correlated, driven by that top-down fear of systemic failure. The fallout could be pretty severe.
Wow. Okay, this is truly a high-stakes morning. We've laid out these two incredibly powerful opposing forces shaping the trading today. On one side, you have this overwhelming macro fear, a potential credit crisis pulling the whole market down. On the other, you have this powerful micro-narrative, mostly around AI and tech, acting as maybe the only real anchor of stability right now. Volatility feels absolutely guaranteed. And based on everything we're seeing pre-market, the burden of proof is definitely on the bulls today. They need to show this credit fear is contained.
The challenge is huge. So for you, the listener, trying to make sense of this as it unfolds, here are the crucial signposts, the things to watch today that will help filter the noise and maybe signal the market's direction. First, and probably most important, watch the financials opening print. How do AXP and TFC actually trade right after their earnings hit the tape? Is an initial gap down met with buying, suggesting optimism, or does the selling accelerate, confirming the panic?
Okay, the opening reaction in financials. What's second?
Second, pay very close attention to the reaction to that 8:30 a.m. data, especially the import prices. If weak data signaling a slowing economy is actually cheered by the market because it seems to lock in that Fed cut, that confirms the bad news is good news. Distress regime is fully in charge. If the market sells off on weak data, maybe we're shifting back towards worrying about fundamentals.
Got it. Reaction to the 8.30 data. Anything else?
And finally, keep an eye on cross-asset correlation. Specifically, watch the relationship between the price of gold and the 10-year Treasury yield. If you continue to see a high correlation, with both gold and Treasury prices rallying together, that indicates the flight to safety is intensifying. If capital is pouring into both hard assets and government debt at the same time, it suggests liquidity worries are getting deeper, and any rallies in stocks might be suspect, probably unsustainable.
That definitely helps bring some structure to what feels like a genuinely chaotic morning. The convergence of all these risks is pretty profound.
It really is.
All right, here's a final thought for you to carry into your day as you track all these moving parts. The market right now seems defined less by company fundamentals. We saw IBKR fall despite beating earnings, and much more by this pervasive systemic fear about solvency. Now, we already know Q3 profit growth overall was expected to slow down, maybe to around 7.2% year over year, according to some estimates. So the critical question for today, the one you should be asking yourself is this. If that financial sector earnings firebreak fails, if today's reports do confirm the systemic nature of this credit stress, what specific macroeconomic mechanism is actually left beyond just hoping for that inverted Fed pivot to prevent a really severe acceleration of the panic we're already seeing? Stay cautious out there and stay informed.